Welcome to Track and Trade Pro and our introduction to the new spreads module. My name is Lan Turner and I'm sitting here with Scott Berry. The first thing I want to do is just introduce you a little bit to what the definition of a spread is. The futures markets provide a variety of trading opportunities. In addition to profiting from rising prices by purchasing futures options or from falling prices by selling futures contracts, there is an opportunity to profit from the relationship between different contracts or spreads. A spread refers to the simultaneous purchase and sales of two or more different futures contracts. Okay, let me read that again. A spread refers to the simultaneous purchase and sales of two or more different futures contracts. Now here's some definitions for you. Spread. The spread is the price difference between two different but related contracts. Now spreading is the simultaneous buying and selling of two related markets in the expectation that a profit will be made when the position is offset. Now here's an example. Now, examples include buying one futures contract and selling another futures contract on the same commodity but different delivery months. Buying and selling the same delivery month on different exchanges, or buying a given delivery month on one futures contract and selling the same delivery month or close to it of a different but related futures market. Now, Scott, go ahead and give us a layman's description. What are spreads?
Spreads are, it's like going to the racetrack. When we trade futures, a standard futures contract or a futures position, it's like betting the horse to win. Now, spreads are much closer to like betting the horse to show or come in third place. What you're doing is you're trading a differential between the two. It's what is considered a partially hedged position because it involves a long position and a short position. You know, maybe we can take a quick look here at a theoretical. Let's look at buying July Chicago Board of Trade wheat and selling December Board of Trade wheat. So let's take a look and assume when we go to put this position on that, you know, in week one the July contract's trading at 285 and December contract's trading at 295. You know, there is a 10-cent differential because the July is trading under the December contract. We say it's trading 10 cents under, or a minus 10. Now let's say a week goes by and our July wheat goes up to, you know, 300, you know, $3 a bushel. We're happy. We're long July wheat at 285. It went up to $3 a bushel. That's 15 cents. $750 before commissions and fees. Now on the other side, we had sold December wheat, and let's say it went from, you know, 295 that we put it on to say 305. You know, it only increased 10 cents. Now we're short that, so we don't like that. We actually lost on that one $500 a bushel. But because the one that we were long, or our July contract, outperformed the one that we were short. What we were long went up 15 cents, what we were short went up 10 cents. We netted a 5-cent differential on this, or we made $250. So basically when you put on a spread, you're saying that the long contract increases in value, or you're betting that the long contract increases in value more than the short contract.
The thing that I had initially had a hard time understanding between spreads, Scott, is that you're not really concerned about the price of the underlying spread or contract. You're really more concerned just about the difference in price between the two that you're looking at, the two contracts. You don't care whether corn is expensive on this contract and looking for it to drop, or you don't care if, you know, either way, you know, what the price of the underlying contract is. You're more concerned about the differential, the difference between the two contracts you're spreading.
Exactly. You're looking at the outright markets are the outright markets, and the spread is a market in and of itself. So it would be almost equivalent to we're going to try to trade the cattle market by only looking at hog charts. They're related, but they're not the same. It is very important to look at when you're trading spreads, and the whole purpose of this software is to look at the spreads. Look at the differential. You're concerned with, is the differential cheap or dear? Not, is the underlying market cheap or dear? Because you make money if the one you're long gains in value relative to the one you're short.
And it doesn't mean one has to go up and one has to go down. It just means that one has to go up less than the other one, or down less than the other one.
Exactly. Like if we looked at in our last example, why don't we switch over and we can see the numbers here and kind of examples.
Is that what you want to go to, the individual contracts?
Yeah, we can take a real quick look. If we're looking at a July-December spread in the wheat or Chicago Board of Trade wheat, you can see in that's kind of a sideways, slightly down trend.
Quite whipsaw. You can see it goes up and down.
Very trade rangey, very, very typical of wheat.
And then, of course, if we look at the July contract, those are very similar.
Yeah, they're almost
exact. We laid them there. They're almost right on top of each other. You can see they're.
Now if we go back to our spread chart, and that
the differential between those two.
Yeah, had a very nice and neat downtrend to it.
Yeah, it's not the whipsaw that we saw in the individual underlying contracts.
Exactly. So looking at the individual contracts, which were kind of generally going sideways more than anything else, looking at the spread chart, it went straight down.
But that's because we're not charting the price of the underlying commodity of corn. We're just charting the difference between the price of the two contracts.
Exactly. We're concerned with the differential, not the absolute price. Now, if we, why don't we look at when you put on a spread position, you have a long position and you have a short position. Now, you can make money three ways. They all end up being the same thing, as you want your long to outperform your short. If they both go up, like we talked about in our first example, where we bought July wheat at $2.85 and we sold December wheat at $2.95, if they both go up, we want to see July wheat increase in value relative to December wheat, which in our first example here, we made $750 or 15 cents on our long position. We lost 10 cents or $500 on our short. The differential in the spread, we picked up 5 cents.
Or now $250.
Yeah, or $250, exactly. Now if we look at the next, they, as you had said earlier, they don't both have to go up. Markets don't always go up. Sometimes markets go down. So let's look at the next one is we can make money if our long position decreases in value less than our short position. So let's say again we bought July wheat at $2.85. We sold Dees wheat at $2.95. Instead of the market rallying this time, wheat prices break. Our July contract drops 10 cents. Goes from $2.85 to $2.75. We're not happy about that. We just took a 10 cent or a $500 hickey on that. Now, we had sold December wheat at $2.95. It dropped to $2.80. We just picked up 15 cents there, $750. That's not a bad week's work. I'm kind of dancing a jig on a per contract basis. But the key thing is why we're truly happy is that the December contract that we're short decreased in value more than the one that we're long, or long. Again, the one that we are long gained relative to the one we are short, or the spread increased in value.
Therefore, we made a profit of $250. Even though we lost $500 on our long contract, we made $750 on our short contract. Therefore, our profit is $250, or the spread difference between those two contracts.
Exactly, and it is not uncommon to see in a market. We could take that same spread we were looking at earlier that, we saw the two different wheat contracts basically going sideways in a very big whipsaw market, and we saw the spread, the actual spread itself, having a very nice, distinct, neat downtrend to it. Now the kind of third situation, if we took care of, win in place, and actually I should probably go with, show and place, because this would be the ideal situation for a spread trader and happens rarely. But you put on the spread, and again we'll buy July wheat and we'll sell December wheat at that 285 and 295, or a 10-cent differential. Buying July wheat 10 cents under December wheat. We don't care what the prices are. We're just buying it 10 cents under. This could be 385 and 395. It could be 1,085 and 1,095. It's the 10-cent differential that we're concerned with. But we buy one contract, we sell the other contract. Now, the best situation that can happen to us is that our long position increases in value and our short position decreases in value. This is the win-win situation. This is when you get absolutely lucky and you find the four-leaf clover. And we can look at the same, we have a lot less movement. Let's say that July wheat went from 285 to 287. We're only looking at a 2-cent move. It's $100, beats a sharp stick in the eye. But it's a very small move for wheat. Now, if we look at our December contract, in this case, drops from 295 down to 292. We picked up 3 cents on that short, $150. In this situation, we
both
again
contracts win, so
yeah,
we win both contracts.
Exactly, and we make 5 cents, which the spread moved greater than either of the underlying markets. That can happen.
So the nice thing about spreads that you're showing us here is that the risk is significantly reduced. Even if one of your contracts loses money, you can still make money in the spread because the other one made more money than the one that you lost, and that's the optimal. And then of course, if both contracts make money, then you get the profit from both contracts. So it's a win-win situation both ways.
Exactly, and you can really see the reduced risk in how the futures industry accounts for spreading. We charge an initial margin. This is how much money you have to get into a contract. Initial margin is a function of risk. The more volatile a contract is, the higher the margin is. The lower the margin, the less volatile, the less risk is inherent in that market. And typically within spreads you get a margin break. Now there is risk in spreads. There's never, now there is, as you saw in 2 out of the 3 examples, an outright futures position would have made more money had we guessed correctly.
But the nice thing about it too is that we can guess incorrectly and still show a profit.
Exactly. There's always risk and reward.
I mean, the optimal is we're always looking for that four-leaf clover. We want both contracts
Yeah.
to go in the direction that we select. But that's not always the case. One will go in the opposite direction, but yet you can still make money so long as the one that you chose to go up or down goes up or down further than the other one that you chose.
Exactly. One outperforms the other, and the one that we're long outperforms the one that we're short.
Right.
Now, that doesn't always happen. There is risk involved in this. Let's look at, we had the same, if prices go up and the one we're long increases in value more than the one we're short, we make money. If prices go down and the one we're long decreases in value less than the one we're short, we make money. Or if prices go nuts and the one we're long goes up, we make money, and the one we're short goes down, we make money, and that's our four-leaf clover. We have the exact opposite of in our risk side. It's possible for prices to go up and the one we're long increases in value less than the one we're short. Such as in this example up here, then we can go down to the next one if we can see prices decrease, and the one we are long decreases in value more than the one we are short. Again, we would lose money, but you'll notice that the spread loss is less than either of the outright changes.
Because the outright change in our long we lost $750. The outright change in the short, we lost $500. But overall, the spread, we only lost $250.
Exactly, and it's the same case when we underperform to the upside. Now, just like we had the four-leaf clover situation, I'm not sure what's the exact opposite of a four-leaf clover, but maybe, the black cat walking under a ladder in front of us. Just as we can have upon occasion, the one we're long goes up and the one we're short goes down, that can happen to you in reverse. Of the one we're long goes down and the one we're short goes up, and
then we have a combined loss on both contracts, and we not just the opposite of making all the money, we lose all the money.
Exactly, and in that situation, in fact, the spread has more risk than the outright futures position, and which can be seen, we'll discuss later on within the video and the seminar, the seminar situation of how to choose spreads and how to look at which spreads are terribly volatile and risky and which spreads you're looking at reducing your risk more.
Well, because there are exchange recognized spreads. There's spreads that the exchanges say these are the ones you should be trading. I mean, for example, we don't go off and just match up anything that we haphazardly want to. There are spreads.
Yeah, we don't like the coffee euro currency spread.
Probably not a wise one. Right.
Exactly, and even sometimes, within the markets, if you understand the markets that you're trading, some spreads that aren't as crazy as that situation can be terribly risky. We happen to pick a July-December spread to show you here in the wheat market. The July-November spread in the soybean market is a notoriously big moving spread and highly risky, and that can be recognized at times by the exchanges or your broker. Will not give you a break in margin for it. You will pay double margin because you will pay a margin on your long position and you will pay a margin on your short position.
It's the exchange recognized.
It's still exchange recognized, but the exchange is recognizing that spread as saying it is risky. And it makes sense in that July soybeans represent, and this is typically in the spring going into summer, the July soybean contract represents soybeans in storage. Well, the November soybean contract represents soybeans, or it's called new crop, represents soybeans that are growing in the ground right now.
So you got your new crop, old crop spread, and that's
exactly.
What you're spreading.
And that can be a notoriously big moving spread in the soybean market, which is volatile. I think I'd have to go back to 72 or 73 to see it to where the exchange said, no, there is not any break given for margins at all. But I can sure remember within the last couple of years seeing, the spread, which normally trades about a third of the outright futures margin. So let's say if the outright futures margin, initial margin for soybeans were 1,000, I wouldn't be surprised to see the spread margin be $300. And I've seen situations where that gets up to 50-60% of it for July Nov spreads. So that's kind of our introduction to spreads.